Welcome to the Deck Dive. Today, we're jumping straight into the Q3 2025 update. Our mission, really cut through the noise of this quarter's results, figure out the strategy, where the money's going now, and how they plan to make it back later.
Exactly. I mean, the headlines scream record revenue, right? But the real story, I think, is this paradox underneath. You've got record financial health, record cash flow, but at the same time, those traditional profit metrics took a big hit. So we're here to pull out these so what from those earnings and sort of map the path from just building hardware to actually monetizing software and AI services down the line.
Okay, let's unpack this. Start with the top line numbers, the things that defined the quarter's success on the surface. Physically, Q3 2025 looks stellar. Total revenue hit $28.1 billion. That's a solid 12% jump year over year. And what immediately stands out, for me anyway, is just how well the operational engine was running. Generated record free cash flow.
And that cash generation, that's really the financial backbone for everything else they want to do. Their cash equivalents, and investments. Well, they swelled to an incredible $41.6 billion by quarter end.
Wow.
Yeah, that's a sequential jump of $4.9 billion
Yeah.
in just 3 months. And almost all of that came from that surging free cash flow you mentioned.
$4.9 billion increase in cash in one quarter. That's just staggering liquidity.
It is. And the SCF itself,
Yeah.
nearly $4.0 billion. That's up 46% compared to last year. Having that kind of cash hoard gives them, serious flexibility, especially when you're facing global volatility or making these really expensive long-term bets on tech, like, say, building out a massive AI infrastructure.
Right. Okay. But here's where it gets, well, complicated and where you really need the context. If they had record revenue and generated all this cash, why did the GAAP profitability metrics just plunge? GAAP operating income was only $1.6 billion. That pushes the operating margin down to 5.8%. I mean, that's a massive 40% drop year over year. How can a quarter be record-breaking and also show such a, catastrophic drop in profitability?
That 40% gap drop, that's the critical number, you're right. And you have to see it as, intentional, or at least that's how the company frames it. See, when they reported non-GAAP net income, it was higher, $1.77 billion. The gap between those two numbers, the GAAP operating income being lower, but the non-GAAP number looking okay, that tells you exactly what they're prioritizing right now. Investment, heavy investment.
Okay, so if the non-GAAP picture is a bit better, what exactly drove that GAAP margin pain? What were the specific drags?
Primarily a 50% increase in operating expense.
So 50%
in the
one quarter.
50%. Yeah, it's astronomical.
Yeah.
And this surge was driven by big increases in SG&A, massive investments in AI R&D projects, and structurally, higher restructuring charges too. They're essentially sacrificing current quarter GAAP margin to speed up that future software monetization. That's the trade-off.
That puts the OPEX increase into perspective. Definitely. But hang on, wasn't there also something about software recognition? Like they got a boost last year that didn't repeat?
Absolutely. That's another key headwind you picked up on. The source material notes lower one-time FSD revenue recognition compared to Q3 2024. See, last year, they hit some significant software milestones, stuff related to the Cybertruck launch, releasing features like Smart Summon.
Right, I remember that.
Yeah, so that allowed them to recognize a big chunk of deferred FSD revenue all at once. Q3 2025 just didn't have that same kind of large one-off software trigger. So the year-over-year comparison looks particularly harsh because of that.
Okay, so we've got the strategic cost of AI pouring in, plus the lack of that software windfall from last year. But did the core business, actually building the cars get more expensive too?
It did, which adds another layer of complexity here. The update mentioned a higher average cost per vehicle. And this wasn't completely offset by lower raw material costs, which you might expect sometimes. The main culprits seem to be lower fixed cost absorption for certain models, meaning maybe fewer economies of scale kicking in there, an increase in tariffs affecting components, and also a shifting sales mix, maybe towards slightly lower margin vehicles. So it's a crucial point. They're fighting margin compression in the core hardware business at the same time as they're massively ramping up R&D spending.
It's a fascinating trade-off, isn't it? Record operational achievement basically fueling deliberate financial pain, at least on the GAAP side. Okay, that sets the stage perfectly for the next bit. The record operational output itself. Let's look at the physical success that actually generated that huge cash flow.
Right. On the deliveries front, they hit a record high globally, totaled 497,099 vehicles delivered. And the core workhorses, the Model 3 and Model Y, they accounted for, 481,166 of those, just cementing their dominance in global EV volume.
And the supply chain health, I mean, that's incredible too. You're talking huge volume, yet global vehicle inventory days of supply dropped significantly, down 47% year over year. It landed at just 10 days.
10 days. Which is, I mean, that's basically producing on demand. Ruthless efficiency.
Right.
It means they aren't tying up capital warehousing unsold cars.
Yeah.
They're building them and shipping them almost immediately. That efficiency is a huge driver of that record FCF we talked about earlier.
And it wasn't just cars flying off the shelves, right? The energy segment is kind of quietly scaling up to be enormous.
The growth rate there is just phenomenal, really. They hit record energy storage deployments, 12.5 gigawatt hours. Is an 81% increase year over year.
81%.
Yeah. That segment is clearly moving from being sort of an accessory business line towards being a core utility provider, you know?
And they introduced new hardware to match that scale. Specifically mentioned the Megapack 3 and this thing called the Megablock. The names alone sound industrial strength.
Yeah. The Megablock is basically the engineer's dream for fixing utility-scale bottlenecks. It's a pre-engineered system, medium voltage, bundles 4 Megapack 3s together. The whole goal is just simplify deployment for utilities, cut down installation costs, time on site, all that stuff. And to back it up, they're planning a massive capacity at Megafactory Houston, up to 50 gigaLevusion annually. Megapack 3 production is slated to start there in 2026. This is infrastructure level stuff.
Okay, shifting back to the cars for a sec, we saw a really clear focus on market accessibility this quarter, which seems to play directly into that goal of getting more AI-enabled vehicles out there, right? Building the fleet.
Exactly. They launched the Model 3 and Model Y standard range in the U.S. Starting prices, $36,990 and $39,990. Both offering over 300 miles of range. This is a really strategic move, aimed at that lower end of the market, trying to maximize fleet density, especially now that the U.S. EV tax credit expired, making their premium models a bit less competitive on sticker price alone.
It's about volume, getting cars on the road. And speaking of reach, the APAC expansion seems critical too. What happened there?
It is. They launched the Model YL in China. That's a specialized longer wheelbase version, 3 rows, 6 seats, tailored specifically for that large family market over there. And an important little detail that often gets missed, South Korea. It's officially grown into their 3rd largest market globally now, just behind the U.S. and China.
It's interesting.
Yeah, it shows they're successfully penetrating multiple, pretty competitive Asian markets, not just relying on China.
Okay, so this record operational success, the cars, the energy storage, that's the fuel, now we get to the destination, the AI and future fleet strategy. This explains that huge OpEx increase we saw earlier.
Right. The whole company narrative now really centers on this AI focus. The core strategy is pretty simple, actually. Every vehicle sold today is seen as a scalable hardware platform, designed to deliver increasing value over time through services. And those services are powered by AI. We're talking about autonomy, obviously, but also things like virtual power plant functionality for grid stability and an energy trading system they call AutoBidder.
And delivering that value, that needs massive compute power, right?
Yeah.
So where exactly is that 50% PX increase going? Is it all R&D salaries?
A lot of it is going into the digital factory floor, you could say. The update confirms they are aggressively expanding their AI training compute capacity. We're talking about bringing their internal supercomputer cluster, Cortex, up to a total of 81,000 H100 equivalent GPUs.
Whoa, 81,000 H100s.
Yeah.
That is a colossal investment in tangible, fixed AI assets. That number alone goes a long way toward explaining that 40% GAAP margin drop, doesn't it? This isn't just a small software team. This is industrial-scale AI infrastructure being built out now.
It's probably the single biggest indicator of their commitment to that Robotaxi vision. You just need that kind of scale to move autonomy from R&D, which is expensive, to commercialization, which should be profitable. And we saw some tangible progress towards that goal in Q3, too.
Right, specifically with the FSD software itself.
Yeah. They began deploying version 14 of FSD, supervised, back in October. What's really significant about V14, apparently, is that it incorporates a large chunk of the actual Robotaxi FSD model, but for consumers. This led to immediate, real-world improvements people could actually see. Things like better avoidance of road debris, yielding for emergency vehicles, stuff like that. It's the closest the consumer version has ever been to the commercial one.
And the commercial rollout itself is starting to look less like a science project and more like, well, a business.
Absolutely. They officially launched the Bay Area ride-hailing service using that Robotaxi tech. So it's not just a beta test for employees anymore. It's an active commercial service, albeit maybe limited to start. They also expanded the service area down in Austin. This shift means they are actively tracking things like fleet utilization and monetization now, not just software safety metrics.
And the signal to the wider consumer market is clear too, isn't it?
Yes, definitely. The Robotaxi iOS app is now available for people to join the waitlist across the US and Canada. This signals they're getting ready for wider consumer adoption, probably anticipating the regulatory shifts needed to eventually move from supervised driving to fully autonomous ride-hailing.
Okay, looking at their official forward-looking statement,
Mm.
they did acknowledge the geopolitical uncertainty, shifting global trade, tariffs, fiscal policies, making near-term volume hard to predict. They aren't exactly hiding from those macroeconomic headwinds.
No, they're not. But crucially, they stress they have enough liquidity to fund the roadmap anyway, which circles right back to that $41.6 billion cash pile, right?
Mm.
And they were very explicit about the long-term profit shift. They expect current hardware profits to eventually be, I think the word was accompanied, by a massive acceleration of AI, software, and fleet-based profits. The trade-off is crystal clear. Sacrifice margin today to secure what they hope will be an enormous slice of the future transport and energy services pie.
So if that profit shift is happening in the future, when exactly does that future start? In volume, I mean. Did the update give a specific timeline for these key products?
They were surprisingly specific, actually. Volume production starting in 2026.
2026 for what?
That timeline applies to Cybercab, the dedicated robotaxi vehicle, the Tesla Semi, and the Megapack 3. So that's like a unified front of massive, hopefully high-margin, next-gen product lines all hitting volume around the same time. And what's more, they mentioned they're already installing the first-gen production lines for Optimus, the humanoid robot.
Yeah.
So that confirms the robotics timeline is moving forward right alongside the vehicle and energy stuff.
Okay, so that 2026 roadmap is really the key takeaway here. But it's being paid for by quarters like Q3 2025.
Precisely. Q325 was defined by that record physical output, more deliveries, more energy deployed than ever before, resulting in phenomenal cash generation. But that cash is being immediately plowed back into these huge strategic long-term investments in AI, those 81,000 GPUs, all the R&D for those 2026 products. And that's what's actively compressing those traditional GAAP operating margins right now in the near term.
So the focus is really shifting, isn't it? From simply asking how many cars did they sell to asking how utilized is the growing fleet. Given that they've launched the Bay Area Robotaxi service, the consumer app waitlist is open, the critical question really becomes, how quickly do those autonomy models need to scale up and integrate into the actual service segment? How fast does that have to happen to realize that anticipated acceleration of fleet-based profits they're banking on for 2026?
That linkage right there from the massive investment in AI compute we see now to the actual commercial fleet utilization rate we'll hopefully see soon, that's the metric you really need to be tracking going forward. We know the hardware is scheduled for 2026. The big question is, will the AI, the software, the service layer, will it be ready to truly monetize that hardware at scale when it arrives?
Yeah, the next year or so is going to be absolutely defined by that question. Okay, that's all for this deep dive into the Q3 2025 update. Go apply this knowledge